So it means the racing bicycle company need to sell at least 400 units in a month in order to have the break even, or in order to have CM equals to fixed cost. This situation. Right, Subhan? CM is equal to fixed cost, right? So that they can have 80,000 fixed cost and their net profit is 0, right? So this is called break even. So now we know that our break even is 400. Recall our definition, the other definition which I told you that it is a little bit difficult, but it's very easy. Like after covering fixed costs, whatever is the CM, it will directly go to the NOI, net operating income. So let's see that. So now, what if the company sells one more bike after the break even, right? So shortcut is, we have covered the fixed cost on 400 bikes. So above we sell one, multiply by the contribution margin. That would be our NOI. See, NOI, that is. So managers, they keep in mind, so that's why the contribution margin approach is very helpful for the managerial accountants, because otherwise they have to make the full statement, complete statement to get the profit, net operating profit. So rather on their hands, they know that 400 is the break even, and above 400, how much we are selling, 21 or 300 or 500, multiply by the break even, that would be your net operating income, simple. So that is the trick. So this is how much useful of the contribution margin approach, because your net operating income is on the fingertips, right? So now you tell me, if RBC is selling 430 bikes and we know that 400 is the break even, how much is the net operating income? 30 multiplied by 30 multiplied by, what is the contribution margin per unit? 200. Answer is 600, 6,000. You see here, 6,000. So we do not need to prepare income statement to estimate profit at particular sales volume. Simply multiply the number of units sold above the break even, multiply by contribution margin per unit. You want to verify?
And even if it's 400 and 450, it will be 10,000, right?
No. Above break even, how much we are selling?
No, I mean if it's 450, not 30, then it's
Yes.
multiplying 50 to 200, right?
Yes, 50 multiplied by 200. So rather just making the whole statement, it would be, you can just easily calculate, okay, 10,000 would be the net operating income. So this is how much it is handy, right? Rather on the computer making the statement, you can just on the fingertips, you can just tell us that is my net operating income. If you are managing your own business, it is good for you as well, right? Now let's talk about the CVP relationship in terms of equation format. So we know that profit is equal to sale minus total cost, right? What is the profit? Profit is equal to revenue minus cost, right? Total cost. Total cost is equal to fixed cost plus variable cost, right? Let's develop this one. We are developing the formula. Okay, we know that profit is equal to total revenue minus total cost, and total cost is equal to variable cost plus fixed cost, right? So if you just enter this negative into this parenthesis, if you remove those parentheses, answer would be, let me clear this mess here. Profit is equal to total revenue minus variable cost minus fixed cost, right? So this is the same. Profit is equal to sales minus, or total revenue minus variable cost minus fixed expenses. So we know that this is just a verification of the equation that we are selling 401. So is it, this equation is good or not? Let's verify that one. So sales, total unit multiplied by the selling price, variable cost, total number of units sold multiplied by the per unit variable expenses minus 80,000 is your fixed cost. Answer is 200. So we verify that this equation is good. Now let's convert this into per unit basis. So we know that total revenue is equal to, let me just call this here, sale price multiplied by the quantity is the here we go. Minus variable cost per unit. So that is the total variable cost here. You can just say that, and total fixed cost here. Total fixed cost, total variable cost. So variable cost multiplied by quantity. We cannot convert fixed cost into per unit. So it is understood that whenever there is a fixed cost, it is a total fixed cost, right? So you see here we have sale price multiplied by quantity minus variable cost multiplied by quantity minus fixed cost. So quantity and quantity common here, so we just quantity take it out. Answer is sale price minus variable cost multiplied by quantity minus fixed cost, right? So if we replace sale price minus variable cost with the CM, instead of writing SP minus VC, can we go down from here? No, okay. So this would be CM multiplied by quantity minus fixed cost is your profit. So that's all that is written in the slide here. So don't just get confused. So in order to convert it into per unit sales, so we know that quantity multiplied by the selling price, Q into P. P is the sale price. Profit is denoted by full name profit. Variable cost per unit multiplied by the quantity is the variable cost, right? So we can write it down like this. Instead, we just take it, if this equation is balanced or not, we put the same data here. Answer is again 200. It means this equation is completely fine. And then we convert, take common Q, mathematical property. Answer would be CM per unit minus fixed cost is your profit, right? So we have successfully developed the unit here. A profit equation in per unit format, right? So now you know that profit is equal to CM per unit multiplied by quantity minus fixed cost. Right, everyone? Junpyo and Subhan, understand?
Sir,
Good. Hello, class. Welcome back after the break. So we were discussing that we can convert this profit equation into per unit basis as well. So we have found that profit is equal to CM per unit multiplied by quantity minus fixed cost, right? This equation. So